I'm Greg Goernert, Vice President and Senior Investment Advisor at Canaccord Genuity Wealth Management and Goernert Wealth Management. Welcome to my channel, where I help you to make some sense of the financial world today. Now, in today's Market Insights segment, where we get inside the markets, I'll be joined again by Canaccord Genuity Managing Director of Advisory Services and former Lipper Award winner Kevin Vandermeer to get his thoughts on the latest market moves. But before we get started, as always, if you like and enjoy my content, please consider subscribing, visit me on my webpage, the link's below, and feel free to add a comment. Anything from what sectors you'd like to see discussed in future episodes to Greg, why don't you ever wear a tie? Now, let's turn it over to our guest today, Kevin Vandermeer. Welcome, Kevin.
No problem. Thanks for having me, and I'm not wearing a tie either.
Perfect. Then you fit in perfectly well. I just had my COVID haircut yesterday. It was very exciting. So
very good. Yeah, I had mine maybe a week and a half ago. So
okay.
Yeah, we're all lining up to get our haircut. That's for sure.
Exactly. I had the mask on and the whole thing. It's a different experience. Now, you just put out a great report a little while ago, actually a couple of days ago. And one of the things you point out, you look at 2020 for the U.S. stock market in a nutshell, and you've got your top 10 picks. And, you also talk a little bit about the maybe a tech bubble, 1999, maybe as a playbook for 2020 to 2021. Can we just start from there and let's move forward?
Sure. So this year has really been a bifurcated market. Some of the best stocks in the world are in the tech sector. They're really benefiting from the stay-at-home trend. The fact that many of us are home, either working from home, and those are companies like Microsoft, Google, Amazon. If you're buying anything, it's usually through Amazon. It's getting delivered to your door. If you're home and you're not watching sports because there's no sports, you're probably on Netflix. So these companies are really benefiting. Facebook is benefiting because if you're running a business, you weren't online before, you need to get online. If you're communicating with family and friends, you may be using Facebook. So what's happened is these companies are really well positioned. They've really benefited from the pandemic. And as a result, the market's picking up on that. And we've seen the tech sector really, really move and really go to all-time highs, actually, through this whole pandemic.
Yeah.
So, that's really stretched valuations. And, when you have these, not only are these technology companies like Microsoft, like Apple, like Google, like Amazon, not only are they expensive or relatively expensive, but they're also large. So they've had a big impact on the market. And so people are now starting to draw parallels between what happened in 1999 and what's happening now, because obviously the technology sector is leading and valuations these companies are not cheap anymore.
Yeah, I remember the tech bubble when some of the logic was that the NASDAQ index had to get to the same value as the Dow, just because the Dow was an old index and the NASDAQ was a new one. And I'm not making that up. It was some of that weird kind of logic that goes on when we start getting into bubbles. So a couple of things you talk about. So let's take a look at the sectors that have been really kind of out of favor. And we did talk about the commodity sector in your report here too. And I'm just looking at a chart of just watching WTI in April get into the negative numbers, like negative, like here, we'll pay you to take it away from us. That I have not seen before. So
and I don't think we'll ever probably see that in our lifetime again. But really, what happened was there was a dislocation in the market. Clearly, what happened was you had producers who were making oil and extracting oil and were processing it, and you had kind of the refiners and people that store oil, and when there was no demand for oil, we were all sitting at home, not driving our cars, manufacturing and plants weren't functioning. You didn't have a drawdown on the storage of oil.
Hmm.
And so what happened was the people who had sort of contracted to store oil basically said, look, we'll pay you not to send us oil
Hmm.
because we have nowhere to store it.
Yeah.
And as a result of that, you saw oil in the short term because there was just nowhere to put it. People were paying other people to keep their oil. Um, that's since corrected, and it's unlikely that that'll ever happen again in our lifetimes. There is obviously, that's there's a yield or an oil curve, and it just happened on the very short end of that curve. If you were to try to run a business and contract out oil and where that oil would be delivered, obviously on the on the outer end of that curve, uh, you know, oil was much more expensive, and now we've seen a normalization with the economy coming back and partially opening. Oil's back to kind of $38. But yeah, we've never seen that before. And I guess in financial markets, we never say never.
No.
But that's certainly one for our careers. Negative oil is
That
incredible.
that was one, yeah. Now, hey, the other thing that you've been bringing up too is that maybe on the U.S. dollar to Canadian dollar front, you might be seeing a sign of weakness there. Do you want to talk about that? Because I know a lot of my
Yeah,
clients have, I kind of stay away from currencies because they're notoriously tricky. But I'll turn
yeah,
it over
yeah.
to you though.
Happy to discuss that. So, in times of stress in the market, or when we get fearful or we get nervous about the markets, and when the markets pull back like they did during the pandemic, what happens is there's a flight to quality. So people
Yeah,
either move out of the markets, they'll move into bonds, and one of the areas that people move into is into the U.S. dollar,
yeah,
and that's just a matter of typically people are buying U.S. Treasuries, which are considered to be the safest instrument if
yeah,
they're not in cash. And so what happens is the U.S. dollar gets bid up. So relative to every other currency, because people are buying U.S. dollars, the U.S. dollar will strengthen. So when you look at, and maybe you can pass that chart around that I sent, at the bottom of the market, you will see that the U.S. dollar will be the strongest against, many currencies, and including the Canadian dollar. And then as kind of fear and risk come out of the market, the U.S. dollar will weaken relative to other currencies
yeah,
and pull back. And so that's really what we've seen. And we've seen probably the majority of the move back. I think we're kind of sitting around kind of 135, 136. And
yeah.
maybe as the economies, Canada and the U.S., improve further and we kind of get back to normal, maybe we see that drift down, a little bit more, so the U.S. dollar weakens, the Canadian dollar strengthens. But it's probably about 133. So most of that move is done.
Yeah.
Is kind of our view, but very, very pronounced, and it's really just driven by fear and the need to get into what we call a reserve currency.
No, exactly. Now, on that report that you mentioned, what I'll do is I will put a link to my website there, and if you click on that, you can contact me and get a hold of that report because Kevin's done a great report here. Now, the other thing you talk about is where do we go from here? Like you've got some U.S. bull market analogs as well as some Canadian market analogs. We've had such a strong recovery off the bottom, from the March lows. Where do you see things going here? Especially now we're in a presidential cycle too. So I want to talk a little bit about that. Democrats versus Republicans, and anticipating perhaps a Democratic win. What might that look like for the markets?
Sure, sure. So one of the things we do as investment professionals is we'll go back and so when the market pulled back as quick as it did, and it was one of the fastest drops that we've ever seen.
Mm-hmm.
The only time the market dropped this fast was in 1987. And so, when we'll go back and we'll try to find, another one of those, if you will. So we
Yeah.
try to find, like, did this ever happen before? And when it did happen, what was the response? And obviously, in each scenario, there's a different reason for why something
Yeah.
happened, but often the results are the same. And so, In the work that we did and that you have, we went back and tried to find, every bear market or every pullback and resulting bounce, after we've had this big move off the bottom, where we've moved, 30, 40%, what then? What happens after that? And we can go back and look at, in the case of the U.S. market, we have a lot of rich data because we can go back to the 1920s and then pull out. So we were able to kind of find 20 of these scenarios where the markets bounce. And then we kind of said, okay, what happens in the next 6 months? And amazingly, the market will continue to go up. Now, in each case, like I said, they're for different reasons.
Yeah.
But the market continues to go up, and usually it's kind of 10% or so. And then we said, okay, that's the U.S. market. Let's go to Canada. Can we find is that the same? Does that happen in Canada as well? We weren't able to get as much data. We were only able to go back to 1982 and 83, so the test period is shorter. But we were still able to find, I believe, 6 scenarios in which the market, when it moved up 20%, what's happened after that. And in fact, the same is true, that the market continues to work in the next sort of six months or so. So by using data, by being evidence-based and data-driven, we feel fairly confident that this market, even though it's moved a lot, and there may be people that feel like, I've missed the whole move, I'm still sitting on too much cash, we still feel confident that this market can continue to work. And really the reason we're confident is based on the analysis that we've done on historical precedents, if you will.
Let's talk about, you touched upon something I think is really important. There's a mountain of cash out there on the sidelines. And I want to get into the presidential cycle in a second, but I really want to talk about this cash, because for people that are market participants or, just casual observers, they kind of look at the economy they're facing and they're going, oh, things are awful. Like, why would you first, I think we do have to understand that the market is forward-looking. It is a leading indicator economically. So first, we have to get our heads around that. But second, talk about your research and what you've found as far as the level of cash and what implications that has to the marketplace.
Yeah. So, we can look at the investments and the amount of money that's sitting in money market accounts, and that gives us an indication of what capital could come into the market. And so right now, we can look back, again, and there's a chart in that presentation that shows you that the cash levels in money markets are really, really high, like higher than they were in 2008. And that really is an indication of fear. And, obviously, none of us that are managing money right now have ever been through a pandemic like this. This is something new.
No.
We can go back and look at the Spanish flu and the implications and what that happened, but none of us, nobody that's helping people allocate capital and make investments has been through this. And so it's understandable that people would be holding a lot of cash if they're not speaking to an advisor or a professional like yourself. And I think the one point I would make is, as much as we're talking big picture here about the markets, it's really, really important that you seek out somebody like Greg to help you. We understand everybody's situation is different. You may be trying to save for a home. You might be trying to save for education. You may be trying to save to support aging parents. So, the great thing about working with an advisor like Greg is you can you can kind of come up with a plan and invest accordingly. But when we look at the markets from kind of 5,000 feet, another thing that gives us confidence that this market can go higher is that there's still a lot of people that are sitting on a lot of cash, and eventually they have to get that money to work. And not just talking about individuals, but we're talking about pension funds and institutional investors that have been maybe too cautious or looking for clarity on the economy, looking for clarity on the vaccine, and as a result have missed the majority of this move. And so that gives us more confidence that this market goes higher because people got to still come into the market.
And that's a good point too, because a lot of that money too is pension money, and they've got obligations to make. So they've got benchmark returns that they have to get, and you're not going to get it in money markets. Now one thing we didn't talk about, I know I had Martin Roberge on the show about 3 weeks ago, and he was talking about the net short positions out there. Do you have any indication where we are net short in the marketplace right now?
Yeah, actually, I had a slide in my presentation that showed that the net shorts were quite short, but in fact, they've come a long way back. And, so the net short in the market has been really covered. And just for the benefit of those that are watching, the net short position is where it's usually done by a fairly sophisticated investor, usually a hedge fund. And if a hedge fund manager believes that the market is going to fall, they will what's called short the market or sell the market with the anticipation that it falls, and then they'll buy the market back. And so there was a fairly large short position, which also gave us a level of confidence that the market was going to go higher, because eventually these sophisticated hedge funds would need to buy back their positions. So they'd need to go in and cover them. And that, again, would at least provide some support to the market. We've subsequently seen that short position is come in quite a bit. So now it's more about the cash that's on the sidelines that needs to kind of work its way into the market now.
I can hear in the background they're coming for you.
That's sorry, I don't know what that is, but
I think it was a siren. That's funny.
Hopefully they're coming for me.
Hey, other thing too, you did make some comments that I thought was interesting, is normalization of timeline for normalization of airlines. A lot of people in the tourism industry and I think people forget after the crash in 2008, how the tourism industry came back. But as an interesting analog, why don't we talk a little bit about your work that you've done on airlines?
Yeah, and I really included that slide in because so many people say, well, when are we going to get back to normal?
Yeah.
Or when do you think things are going to be, come back to normal? And I was actually in New York for 9/11. So I was there.
Right.
I felt for the full force of that terrorist attack. And I remember thinking, I was a little bit younger than I am today, that that the world,
we all are.
The world had changed, and it would forever change. And I obviously didn't take a plane back from New York. I took a Greyhound bus home, and I wondered if we would ever fly again. And then you remember the years after 9/11. We had to take our shoes off, and whenever you flew, you kind of looked at the person on either side of you, and then eventually that kind of went away. And I remember when we used to, we weren't allowed to park under sporting events.
Right. Yeah.
You had to stay a certain distance away. And then eventually all of this sort of quietly things returned back to normal. And I think the only thing that's kind of left from 9/11 is a beefed up security system on the front end of whether you're flying out of Edmonton, Alberta, or Toronto, there's a fair amount of security. And I think, as we think about the world, and that analog that I gave you, or that somebody put together, just kind of showed that, airline traffic is starting to pick up. And if you kind of draw a line, it's probably a year from now that we kind of maybe get back to normal. And there's a lot of people saying, well, we're never going to get back to normal. It's never going to be the same. But we are creatures of habit. I'm pretty sure that we're all going to go to our favorite restaurant. It might not be next week, but a year from now, we all might be getting on planes again, and we're going to be, pressing the flesh. We like to do business face to face, and the world might change. We're not sure what will be the remnant of that of this pandemic, but I think the world will look a lot more like it did before than different. People, we've talked about wearing masks, and I was reading an article last night. It talked about people even, in the 1920s didn't like wearing masks either.
Right. Yeah.
And so I don't know how long it will be, but the point of that slide was it probably takes a year for us to get back to normal. But I think the world's going to look a lot like it did previously.
Well, and that's the thing. Humans as a species, we're incredibly resilient and adaptive, and and I like that slide just because obviously there's no guarantees in that, but it shows how we will normalize and we'll get back to normal. Humans are social animals. We will get back to being social. The world will be similar to the way it used to be. I mean, there's going to be little quirks, as you said, with that, but it's going to be okay, really.
Yeah.
It's going to.
One of the amazing stats I heard, and this was about a month ago, the cruise ships, again, it's kind of, discretionary spending and travel. And I've probably been on 10 cruises with family and friends. So, I'm not a big cruiser, but I've been on a number of them. And, but I don't think I would necessarily jump on a cruise ship. It's not the first thing on my item after this pandemic.
No.
But I guess people who had prepaid for cruises, they offered them either cash or a credit. And I thought 95% of people are going to ask for their money back.
Yeah.
And it was more like 75% of these people said, I'll take the credit. And if you give me a really good deal on a cruise, I'll rebook. And
that's great. Yeah.
Yeah. That just shows you, like, I thought, wow, we're probably not going to change as much as people think. And don't take my word for it. You can Google that. It's just an amazing stat that says, to your point, we're pretty resilient.
Yeah, I mean, I think 9/11 was a good example of that, because I agree. I thought, at that point, as I was younger too, I thought, the world's never going to go back to like certain things. And I remember when the cruise ship industry came back, I was like, or the airlines, and people have an amazing ability to forget, which sometimes is a good thing, sometimes is not so good things, and that's why we're there to remind them. Hey, one last thing before you go, and I want to say this again, Kevin is one of the hardest working people in the industry, and I really want to thank him for joining us tonight, his time. But last little bit that we talked about, presidential cycle.
Sure.
Let's talk a little bit about that, because that's one of the worries that are out there right now.
Yeah. So what's interesting is, obviously Trump was kind of leading in the polls. Biden, almost out of nowhere, got the nomination for the Democratic Party.
Mm-hmm.
He was lagging for a while. Now he won the nomination. And then suddenly he's now surging. And I read this morning, I think he's kind of 15 points ahead.
Oh, yeah.
It's quite amazing, actually. And really it's been more that Trump has mishandled this second wave, and where he needed those votes are where the second wave of the pandemic in the U.S. is hitting hard. So Florida, Texas, some of these other areas that were traditionally Republican, he's feeling the brunt of that. But yeah, I think initially I would have said maybe a month ago the market would have viewed Biden as very negative. And so people have been doing more and more analysis on what does it mean when a seating president is unseated, and it's usually unusual. Usually, a seating president usually is reelected. You think of, Bush being reelected despite 9/11, Obama, Clinton. There's numerous examples of a president getting a second election, but and typically when a president doesn't get reelected, it's because the economy has been in a recession, and we're obviously clearly in a recession, but for different reasons. And so as we again go back to being sort of data-driven, looking at what happens when a president is not reelected, or if a Democrat comes, And actually, amazingly, when you look at the data, it's actually quite positive. So we would look at, even if Biden were reelected, we think the market can still go higher. Now, what I would say is that Biden is probably going to bring in tax reform quicker than, say, Trump would. So taxes in the U.S. are going to go up. Biden's already said that he would roll back some of the tax benefits to corporations. So we'll probably see a hit to earnings in the S&P 500. But Biden's also going to make some investments in infrastructure and renewable. So there are some industries that will benefit from that presidency. The other thing I read recently, which you may remember, but Michael Dukakis ran against.
I remember that. Yes.
Yeah.
I think he was 24 points ahead of.
I had read 19, but he was 19 ahead of George W. Or Bush Senior.
Yep.
And eventually lost. So, and then obviously remember what happened with Trump, or Hillary Clinton. Everybody thought she was a shoo-in, and then out of nowhere Trump. So, again, we're reminded of the fact that this is politics. The polls can be wrong. Anything can happen. But I think that the general sense right now is that probably Biden wins. Yeah. And maybe people thought, with a Biden win, that might surprise the market. The markets may sell off.
Yeah, that was my thought.
Yeah, but I think we're now kind of warming up to the fact that Biden, while he might be bad for some sectors, may also be good for others, and may not be that bad. And so that's kind of the work that we did there, or relied on someone else's analysis and presented.
Yeah. And we're not pollsters here. What we try to do, though, is we have to deal with the markets that are given us and the best information we have. So that's what we have to do. So now really appreciate, once again, you taking the time to join us. That's a good overview. So right now, sectors that you're looking at, we talked a little bit about them. We talked about cash on the sidelines. We talked about fears that are out there right now and normalization coming back. But your position on the markets right now, relatively bullish? Yeah,
I would say. If somebody said, what do I think the markets will do over the next 12 months? I would say, probably TSX, S&P probably does 7%, which has been sort of the long-term average. Year to date, the Canadian market, I think, is down kind of 8%. From here, I think we could do 7-8% 1 year out. Same with the S&P. Obviously there's no straight lines. What we'd like to see, I think tech maybe sells off a little bit, but I think the fundamentals in tech are strong. Yeah. We're using, everybody's still using their iPhones. Everybody's using Google. Everybody's using Microsoft. We're still going to probably get things shipped to us by Amazon. We're still going to watch Netflix, and those companies have huge moats around them. They have bulletproof balance sheets. They have positive cash. So I like tech. I would maybe wait for a bit of a pullback here on technology. Yeah. Gold, we didn't talk about it much, but gold is really kind of at an 8 or a 9 year high, with interest rates being so low and negative real rates. Quite negative. What does that mean? It means that, if I put money in the bank, I'm not getting much interest, and then I have inflation. So prices keep going up. So my $100 in the bank could be worth, purchasing power could be 98 next year, and 94, and continue on because inflation eats at that. So people are moving into gold as a store of value. I'm not a self-proclaimed gold bug. What I am is an investor, and we can see that the gold as a commodity has been one of the strongest, far better than silver or copper or oil. Yeah. And the way to get exposure through that would be some really high quality gold companies. So gold has been in the commodity space, it's been strong. And then, some industrial companies, as the economy comes back, selectively looking at, that whole industrial space as the U.S. economy and the Canadian economy come back. But in terms of our favorite sectors, technology continues to be, but you'd want to be selective there at this point because there's been such a run. Gold companies in the commodity space would be strong, and then industrials, and then finally the banks. But I think we want to make sure that we're clearly through the bottom of the overall economy, and we have a clear line to improvement on the economy before you add to banks. Banks in many ways are kind of a play on the economy, and so you just want to be really careful. Some of the big U.S. banks are reporting now, and they're literally putting billions of dollars aside, reserving against what they expect to be poor loans or bad loans. Not surprising. Yeah. So I think it's a little bit early on the banks, whether it's in Canada or the U.S. Just wait for a little bit more clarity. But those are some of the sectors that we like, and overall we would be positive on the markets. And again, can't stress enough that use the expertise and knowledge of people like Greg to develop a plan. Everybody's situation is different, and it's great to have a plan to know how to achieve the financial goals that are different for you and from someone else. But using somebody like Greg to help you achieve those financial goals, whatever they might be, is critical and important.
Well, hey, on that note, thank you so much for joining us, and I appreciate the plug anytime. So Kevin, thanks for joining us. Just going to lead us out right now. Once again, Kevin Vandermeer.
Thank you.